Today we're going to be working with a program trading strategy called linear regression. Anyone that's really taken a statistics course probably knows about this already, but has, like most math classes, did not realize that it had any practical use outside of the classroom. So, you can use it as a program trading technique, or you can use it as a technique on your own. We're going to go onto Excel to calculate what the slope of the actual linear regression is, and that's what we're going to be trading off of. A linear regression line, all it is it's basically a line of best fit to the data. Okay, that's the simplest way I can put it. So we'll go to Excel, and I already plotted some data here, and we have 1, 2, 3, 4, 5 on the x-axis and 5, 4, 3, 2, 1 on the y-axis. I mean, as the y values and the x values corresponding. So to get what the slope is of the linear regression, we're going to do the Excel function slope and then start a parenthesis, and then it says known y's, comma, known x's. So we highlight the known y's, and then comma, and then we highlight the known x's, and then end parenthesis, and we see the slope equals -1. Alright, now that means that for every increase of 1 in the x column, the corresponding value of the y column is going to go down 1. So it's a perfectly inverse relationship. Now I'm going to put this in a chart just so we can actually see how it fits. And we'll go to first highlight the data, then insert, and we'll use a scatter diagram just to show. And there's our scatter diagram. Now take a look here. We're going to now go to see if we can actually put the line of best fit in. Okay, we're going to see if we can put the line of best fit in, and I'm going to go to see what formats I can use at the top. I think that's the one. Yep, there we go. That is our that is the equation of our linear regression line. And it's just a simple y equals mx plus b. Anyone that's taken algebra probably already knows that. So the equation of this line, which is the line of best fit or linear regression line, is y equals -x plus 6. And like I said, it's a perfect relationship. Now let's go to something that isn't perfect. Let's see what happens if I change this line to 6. See what happened to the chart? First, the slope of the line is now -1.2. Alright, so now the line of best fit is y equals -1.2x plus 7, and the relation is not as strong as noted by this r squared value, but I won't get into that. Okay, so our basic theory is going to be when the linear regression line turns up, we're going to want to start to be buying into the market, and when the linear regression line turns down, we're going to, and I mean the slope turns down, we're going to want to be selling or selling short. All right, so the value that that we're going to set as our barrier so we don't get that many false signals, because when the market's moving sideways, it really messes things up. We're going to do if slope is greater than or less than 0.13, then trade. Alright? It's not too tough, alright? If it's in the middle, if it's between -0.13 and +0.13, and I'm using this number because that's basically what my certification book, what is it called? New Trading Systems and Methods. That's what it says. Okay, so anytime that the slope of the line of best fit is between -0.13 and +0.13, we're just out of the market. Simple as that. We're sitting out. Okay, so we get the point. Now we go to our chart of the S&P 500. Yes, well, no, this is the Dow Jones. Yes, it looks intimidating. This is 1 year, and we're thinking, what can we do with all these data values? Do I have to put these all in to a function? No. Apply studies. We're going to go to a linear regression trend line, as you see on the side. Then apply study, and that will automatically fit to the timeline. And now, one very important note about the timeline. As we see, it's a much slower to react line than when we move to a shorter time frame. All right, and we see it change. We see it change, and because of that, because it's much slower to react, the risk is much higher. All right, so by the time the linear regression line is there, and it's gone down this far, it's gone down this far, the line still might be pointing up and we still might be in the trade, okay? So there's much more risk when you're doing long term. Now if you're doing short term, you'll be taking more tiny losses, but you'll also be probably making more since you're not risking a lot of money, all right? So here's our linear regression line, the blue. That's our 1 year, and here's our 2 year. Here's our 5 year. And it's basically just an automated trend line. Then we go to 3 months, definitely up. We go to 1 month, definitely up. We go to 10 days, up. We go to 5 days, up. 2 days, down. And 1 day, up. Alright, so you're probably thinking, okay, so when do I trade? You trade when this happens. We're going to apply one more study, and that is the linear regression slope, as you can see right here. And we're going to use the time frame that the program provides us with, which is the 14-day. Well, no, that's the 14-day, I think. Yeah, 14-day moving average, or 14-day, yes, 14-day time period, my bad. Alright, so we want to buy when our linear regression slope is higher. We want to buy when it's higher than 0.13. We want to sell when it's lower than 0.13. I'm going to get rid of this volume here. Okay. Put that up. Okay, so I'm going to set a band right here at about 0.13. I'm going to set the second one here at negative 0.13 or thereabouts. So in essence, we would be buying here, and we would be staying in the market. And as we see, you follow the time frame from the point of buying at that point to the point where it breaks under, which we would sell right there. We just get out of our position. From that point until it breaks below, we would have made a profit, okay? And then we would be out of the market, and then we would sell right there, okay? And if we sold right there, we will call that, we'll go in the middle, and we held it until it broke above that negative 0.13 again, and we were shorting here, we would have made a profit, okay? And then here's a false signal right here, and like I said, this is far from perfect. We'd be buying right here, and we would be selling right here. So that's next to nothing, that one there. And that's going to be our buy. And then we would be short selling here and buying back there. So if we short sold at that point and held it until that day, like I said, it wouldn't be a good profit, but the best way to profit from this is when the market isn't moving sideways, but when it's moving in a defined trend. Alright, like, take a look here. We'll go to the last one that's going on. We see a buy signal there and a buy signal here. I'll draw my last two trend lines to show you how much money we would have made. There's one. We would have made money on that. And we would have made a lot of money on that. And we'd still be in that trade. So as you see, it's a great way to take the emotion out of trading. And just using one of these slope oscillators and using the 0.13 bands to determine whether you're getting in or getting out, it's an absolutely great way to profit. And with these bands here, it really gets us out of the times when the market is just noisy or somewhat in a range that's just bouncing around in. So that's your way to do it. You can set the period to what you want, like I said. If you set the period to a long time, like right now we're at 14 days, and we're not taking too much risk. We're taking probably about 2% of our account value for each trade. But if you set the value longer, you're going to take a lot more risk, but it's probably going to be more dependable over the long term. But in the short term, there's a good chance you'll lose some money. All right? If you have any questions, please feel free to ask. Most charting programs, and these are programs like I'm using Thinkorswim by TD Ameritrade, most charting programs will give you this, like Thinkorswim and TradeStation and eSignal, but as far as a broker provided one, you're not going to have that kind of luck. Alright, I hope you learned something. Hope I didn't confuse the listeners too much, but it's a great way to trade, and if you can actually program it into a formula, just imagine you're making money and you don't even need to worry about when you're buying or selling because your computer's doing it for you. Alright guys, thanks for listening.